In May, we saw the first AAA bond, commercial mortgage AAA bond being hit, backed by a single office property. And then we started digging into basically the data to see what other buildings could get hit. And the result is there's a few. A ton of the office properties across the U.S. have been distressed for years. It just takes a long time for that to reach bondholders, and now it's starting to get there. So we kind of analyzed the data. We saw at least 12 other buildings are said to have some type of loss. Some will be at the AAA level, some will be just the investment grade portion, but there's definitely a lot of more pain to come.
Which regions across the U.S. are most vulnerable?
It's all over the U.S. actually. We saw there's buildings in New York, of course, Chicago, LA, San Francisco, but there's also buildings in Kansas City. It's kind of everywhere.
But if I'm holding a AAA bond, I expect to get paid back here. So what's happening to these bonds? Are they coming up for maturity, and then the owner has to refinance the bond, or how's this all playing out?
Sure. So every AAA bond holder thinks they're going to get paid back.
Exactly.
That's why you buy it. But they a lot of these buildings have not been receiving interest on the bonds for a while, and the minute the appraisals drop and kind of the owners of the buildings get rid of them or sell them, the losses are realized, and the gist of it is that the buildings are worth a fraction of what they were worth a few years ago. So there's just not enough money to pay back everyone, not even the AAA holders, and that's the whole issue. The real estate is just not worth it.
When you're speaking to AAA bondholders, what are they telling you as far as why they might still be holding on to that? What's the risk reward?
A lot of the AAA bondholders will get some money back, the lower tranches won't. And I'm not sure if there's a market for that type of, those type of bonds at the bid they may want them.
And I'm looking at, you have this big take story, which means it has great graphics in addition to being well reported, well sourced. Some of these buildings, New York, Chicago, LA, West, 555 West 5th Street, 725 South Figueroa, I know that building. But these things are being valued at significant discounts, right? And some not even covering the amount of the outstanding loan. Yeah. So that's where the problems come in.
Yeah, that's the problem. And it's also a lot of these buildings depend on one single tenant. So the minute that tenant's look, my lease is up, I'm leaving, I want a newer office, this building is really old, the bonds just drop in price because that's where they're getting the income.
I think anytime it comes to anything revolving around real estate, as we know very well, people want to harken back to the global financial crisis in 2008, but this is a very different situation, especially coming out of the pandemic. And talk to us more about how this is a very small subset of the bond market when you're looking at this.
Yes, definitely. There's definitely some type of echo to the, similar to the financial crisis in the sense that you don't really see losses on the principal level in AAA bonds. That hasn't happened since 2008. Mm-hmm. But again, it's just a few bonds within the commercial mortgage-backed securities market.
Right. So when you're speaking with your sources, what are the risks of other broader ripple effects or any sort of other red flags potentially brewing? And then maybe the offside of that where there's more optimism of what could happen?
Yeah, I think the risk is mainly for any building that's old, and that the tenants are walking, there's going to be issues. But if any new building that has a great reputation, has a lot of tenants, that market is kind of booming. Right now in new issue markets, buyers are just gobbling up the debt. So it really depends on the building.